Let's talk about real estate investments and other high-risk investments. Because of the risk involved, the uncertainty involved with investing in these types of assets, many people don't want to choose to invest in these types of assets, and as a result, these types of high-risk investments can result in very high returns. But consequently, you also face the chance that these types of investments will lose all of your money. And so for this reason, in particular, it's a good idea to never put more than 10% of your own overall wealth in these types of investments. The exception to this general rule might be if you are a professional real estate investor, like your main day job is the business of investing in and developing and fixing and renting out properties. But for most people, this is a good rule of thumb. So with that caveat in mind, let's take a look at how you can actually make money investing in real estate. Not for buying your own home and living in it, but for buying properties and renting them out. And when we say real estate, there's actually many different components to making money in real estate, because property can consist of land, but it can also consist of the structures that we're used to thinking about, like apartments and renting out apartments. And there's other types of income from real estate as well, such as mineral rights, the right to extract things from the ground and sell it. And each of these different types of ownership in real estate involve actual legal title. Legal title means who owns it and who is recorded as owning it as it's written down and recorded in government records. If you own legal title to something, you own it unambiguously. So the first thing to think about if you're going to invest in real estate is to be prepared before investing, because real estate investing actually has a lot of lead time. There's a lot of prep work that needs to take place in contrast to buying a stock or something like that. First of all, it takes time to line up financing. Getting a loan can take a couple months. And you'll have to have good contact for a building inspector, people that you can rely on to take care of repairs for you. You kind of have to build up a network of people, of contacts, to handle this or that particular detail involved in the transaction. And you'll have to have reserve funds, like money set aside so that you can cover 3 to 6 months of expenses without needing any income to cover that expense. There's basically cash in the bank in case that you're not able to generate revenue for the first 3 to 6 months. It's good to have that cash to cover the expenses to make sure that you can actually hold on to this property safely. Many professional investors set up limited liability corporations that actually own the real estate, and what that does is provide one extra layer of legal protection for you. If you rent a property and your tenant sues you, for example, for whatever reason, maybe they got injured, they can sue for whatever assets the limited liability corporation owns, but they can't go after you and your individual wealth. Like, for example, they can't go after the home that you own yourself or the cash that you have in your personal bank accounts. Those are protected when you run your investment through something called a limited liability corporation. And so when it comes to making money in real estate, there are 2 different ways to do it. One is through current income, and the other is through something called capital gains. Capital gains relates to the price appreciation on an investment. If you buy a home for $100,000 and you later sell it for $200,000, that's $100,000 in capital gains, profit. But if you rent the property out in the meantime, you're earning current income on it. That rent that gets paid, that's income that goes to you. And the yield, the rental yield, is the ratio of that income for the year relative to the amount of your initial investment. Again, like basing our example of buying a property for $100,000, if that rents out to people for $7,000 a year, then your rental yield is 7%. The 7,000 divided by 100,000. So your income comes from that rental yield, plus any anticipation of selling the property later for a higher price. Capital gains. Now, one thing about capital gains, as well as rental yield, is that they are both taxable. So if I make $100,000 on my property sale, I have to pay $100,000 times whatever tax rate I face. If my tax rate is 30%, then $100,000 times 30%, I pay $30,000 in taxes. The exception are these two things: capital improvements and repairs. If I, for example, spend an extra $20,000 to build an additional bedroom on this property that I bought, that's called a capital improvement. And so if I bought this property for $100,000 and I spent $20,000 to increase its value to build a bedroom, well, then if I later sold it for $200,000, then the taxes I would have to pay are not on the basis of $100,000. Instead, I have to pay taxes on the basis of $80,000, accounting for this extra money I spent on capital improvements. So, for example, if my tax rate was 30%, then that means here I'd pay taxes of $24,000. So, capital improvements, in a way, are tax deductible. The deduction, though, occurs when you actually sell the property. Here, assuming I sold it for $200,000. That's similar but different to the way repairs are treated. So if I spend money on repairs, maybe I need to just paint or something, and it's $1,000 for that year, I deduct that $1,000 from my taxes for this year. So if I had, say, $7,000 in rental income that was coming in each year, well, normally I would have to pay 30% of that in terms of taxes. So I pay $2,100 in taxes. But if instead I had to pay for painting for that year, then that's going to deduct from that rental income, meaning that my tax bill is consequently lower by about $300. I pay $1,800 in taxes that year. So that's what it means when these things are tax deductible. Capital improvements, tax deductible, but only when you sell the property. Repairs, these types of smaller items, tax deductible for that given tax year. So there's a big relationship between taxes and real estate investing. There's actually a tax advantage of real estate investing that's not there in almost any other asset. That's called depreciation. Depreciation is this weird sort of thing where, again, it's like nowhere else can you do this, but let's say we bought that property for $100,000. The tax code says that you can deduct 1/27.5 of it. Don't ask me why it's 27.5. I don't think anybody knows. Or that's about 3% each year. 3.5 or 3.6%. You can deduct that from your taxes. Here, that's $3,600 or so in tax deduction each year. And the thing is, that's different than here where we had tax deductions from repairs or capital improvements. Here we spent $20,000 to build that bedroom, and that's why we got to deduct that amount from our taxes. Here we spent $1,000 to paint, and that's why we had a slightly reduced tax bill at the end of the year. But with depreciation, we didn't actually spend $3,600. We didn't actually spend anything. It's just we sort of got to deduct 1/27th of the purchase price of our property from our taxes each year. And the idea is that the IRS or the tax agency is allowing us to deduct the value of the property each year because there's this expectation that the property deteriorates physically over 27.5 years. But in reality, especially if you think about San Francisco, most properties are much older than 27.5 years. And so what this ends up being is this extra tax advantage that's there in real estate that's not there in other types of investments. By the way, depreciation is only something that you can deduct if it's an investment property. If it's like your own home that you're living in, you can't deduct this depreciation. But for a investment property or your own home property, you can deduct the interest. So this is another tax deduction to consider. Interest is going to be a function of how much money I've borrowed, the leverage, in other words. And another way to think about leverage is this loan-to-value ratio. The ratio of the purchase price or the value of the home relative to the size of the loan that I got to buy it. I might, for example, have my $100,000 property that I purchased, but I only put up $20,000 of my own cash to purchase this property. And the rest, the remaining $80,000, is a mortgage, is a loan. This is kind of a common ratio of the amount of your own cash that you have to put up relative to the purchase price of the property, 20%. And the thing is that an $80,000 mortgage, you will probably have an interest rate associated with that. And so each year, if your interest rate is, say, 3.5%, that means you're paying $2,800 in interest each year. This interest that you pay is also something that you can subtract from your taxes. That is deductible. And so let's say my first job pays me $40,000, just to get a sense of how this would work. If I make $40,000 a year and I pay 30% in taxes, that means I pay $12,000 in taxes each year. But if I own a house, whether it's an investment or for my own house, I can subtract any interest paid for that year before I actually have to face taxes. So if that's the same 30% tax rate, if I consider the cost or the benefit of this interest tax deduction, $11,160 is my total tax bill. And so by paying an interest expense of $2,800, that is a cost in terms of that's just an amount that I have to pay to the bank, but that also comes with a tax benefit of the difference between what I would have to pay without the interest versus what I have to pay in tax now that I have this interest deduction. Here, a tax benefit of $840. So this tax benefit from tax deductibility of interest is another benefit that's there in real estate investing. One final thing to note is that depreciation is only applicable to the building value. And separating building value versus the land value is kind of tricky. Oftentimes people just use ratios, like say 30% to land and the remaining 70% to the building. But it is a factor to consider. So you can only depreciate that part of the property price that you paid for the property that's attributable to the building. Land doesn't depreciate. Okay, another consideration is that capital gains are taxed differently than income and dividends, at least at the time of this recording. At the time of this recording, capital gains are taxed at a lower rate. And so if you sell a property, our example again, selling it for $200,000 after you paid $100,000 for it, you have a capital gains of $100,000. You profited by $100,000. And so then you have a capital gains tax of 15%. In this example, your taxes will vary by year to year and whatever is going on with politics, but generally capital gains tend to be taxed at a lower rate relative to something like ordinary income, the income tax rate that you face when you earn money from a job. And if we compare the difference between the two both make you money, but the difference is that if you only pay a 15% tax rate on your capital gains, then you pay $15,000 in taxes, which is still a lot of money. But compare that to the tax rate that you would have to pay if this were like wage income, a 30% tax rate. You pay quite a bit more in taxes. And so capital gains versus ordinary income, here we're looking at the same amount of profit, but we're saving $15,000 in taxes just because it's capital gains instead of ordinary income. So that's another benefit of real estate investing, is just another, again, a tax savings aspect. And there's one last tax savings aspect to real estate, and this is a little bit more of an advanced topic, but you see it oftentimes with investors who buy and sell a lot of properties, something called a 1031 exchange. And that's a situation where, let's say I purchased this property for $100,000, I sold it for $200,000. Normally, I'd be taxed on that $100,000 at 15%. But if I do a 1031 exchange, there's this $100,000 in profit. If I roll that profit into a new property within a certain time period after selling this old property, let's say now I take the $100,000 of profit and I purchase a house that's $200,000. So I take my initial investment and my profit to buy a $200,000 house. The benefit of a 1031 exchange is that I can avoid paying taxes on this $100,000 profit. Because I rolled the money into a new real estate investment, I avoided paying a 15% tax rate on all that profit. And I can do that for as long as I own this house. If I sell this house, some years down the road, then eventually I have to pay that 15%. So it's not tax-free, it's tax deferred. But the thing is, I could keep buying a property again and again, and I can keep repeating this step. If I sell this property for $300,000, just for example, and so again I've got a $100,000 profit, I still don't have to pay a 15% tax rate, because then if I purchase a property that's $300,000, it's purchased with all of my profit. And so with a 1031 exchange, I can continue deferring for as long as I'm an active real estate investor. That's called a 1031 exchange. 1031 because of the IRS tax code. So that's the benefit of purchasing, and that was under an example where we continually were expecting to sell properties for a profit. But we need to be able to sell properties for a profit, we need to be able to make sure that we're paying the right price, that we're not paying more than what we should be paying. And so when it comes to the price to pay for real estate, one of the ways that investors will figure out the right price to pay is something called the discounted cash flow method. And really all that means is that what they do is they look at a property when they're thinking about buying it, and they think about how long they're going to hold it. This person, for example, is looking at 5 years. And then at the end of 5 years, they're expecting to sell the property. And here they kind of have to come up with best estimates about how much money it's going to make in rental income each year. $4,000 the first year, $4,100 the second, $4,200 the third, and so on, as well as an assumption about what they're able to sell the property for at the end of 5 years. Here for $230,000. And the math we can kind of skip over, but basically, if you were to accept $230,000 today, or have the choice of receiving $230,000 5 years from now, you would probably select the choice to get it today. And that's the reason is that you could take that money and you can go out and do stuff with it. You can invest it over the next 5 years and end up with something more than $230,000, something more than what you started with in the first place. So having money today is always more beneficial than having it in the future if we're talking about the same amount of money. And that's what this idea of present value is. So we have to take these expectations about how much we're going to make in the future and kind of convert them into today's dollars using this present value factor here. What's happening is that these cash flows are getting multiplied by a number less than 1, and that's representing, which is shown here, the fact that a dollar in the future is worth less than having that same dollar today. But the point, regardless of looking at present value or future value, is that you take the expected dollars that you're going to get in the future, discounted to today, and the sum of all that expected profit from rental yield plus the final capital gain is the present value of the property, of what it's worth. And that's kind of how investors figure out the maximum price that they would pay for this property. And as far as financing these investments, these purchases, you may not have a full $198,000. That's a lot of money to have just in a bank account. What's very common is that financing occurs for a real estate investment. You'll have mortgage rates, you'll get a mortgage, just like we saw in previous chapters. The only difference is that if you're buying a property for an investment rather than for your own home, the interest rate on that mortgage is going to be more expensive. Not a lot, but sometimes it's, 0.5%, up to 0.5% more expensive. Another option is that the seller might finance it for you. They might agree to kind of give you a loan for the purchase price of the property. But again, the interest rate on that is even higher than that of a mortgage rate. So this option is more for if there's no other option that you can't get a mortgage on your own. And there's this idea of sweat equity property. It's related, but it's the idea where you find a cheap property that has a lot of things wrong with it. Maybe the roof is leaky, the siding needs repair. You buy it for a cheaper price, and you make the repairs yourself. And the benefit is that the value of that property increases by the amount of repairs that you made. That's called sweat equities because you're spending a lot of time to improve the property, and you're sort of like contributing labor to increase the value of the property. Sometimes people talk about timeshares. I can generally just say it's generally a good idea to avoid timeshares in the purchase of any timeshares. It's kind of scammy. People who buy timeshares, they have this sort of right to use the property for 2 weeks out of the year, but they end up facing a lot of annual costs involved with that, as well as the upfront cost of purchasing it. And it's very difficult to sell that property later. It's very difficult to sell your interest in a timeshare to someone else if you don't want it anymore. Sometimes you can't even give away that timeshare contract because it comes with such a high annual cost that no one even wants it. So these are generally very bad ideas as an actual investment. All right, so we talked some about the advantages, especially the tax advantages. We should talk about some disadvantages as well so that you've got a balanced idea about investing in real estate. There are some types of risks that you face in real estate, particularly because you have financing involved. So you have something called interest rate risk. You might get a mortgage and maybe it's at a cheap rate, but if interest rates rise later and someone wants to buy your property, well, if interest rates are more expensive, then it's more costly for those people to get a mortgage. And so they're going to be able to, as the monthly payment is higher, they're not going to be able to pay as much on the purchase price as you might have been able to when interest rates were lower. So as interest rates tend to rise in the economy, the prices of homes tend to fall in value because of this affordability idea. So when you buy a property, you actually gain exposure to interest rate risk, to what's going on in the overall economy and what's going on with interest rates. Of course, that can work both ways. If interest rates fall, then the affordability of that same home increases. People who can now get loans, they can get them at a cheaper interest rate, they can afford to have a higher purchase price. Another risk is that of foreclosures. Sometimes you have these markets where a lot of homes, people stop paying their mortgage, and what happens is those homes get sold pretty quickly. They get put on the market, and the bank who now owns the property wants to sell it as soon as possible. And so if there's a place where a lot of foreclosures are happening, that's going to depress property prices for all the properties in the area. Because why would they pay, a high price for a home when they can go and buy a foreclosure for cheap? And so you face a risk that the property values in the place that you invest in will fall whenever there's a lot of foreclosures in the area. Another consideration is the high transaction and legal costs, mainly the transaction costs. When you buy a home, you don't really face transaction costs. The transaction cost is paid by the seller. But let's say you bought a condo in San Francisco for $500,000. So that's fine. It's very expensive, but whatever. But then maybe you sold it a couple years later for $600,000. And you would think that that's a $100,000 profit, and that would make sense. But the thing is, you have to pay a transaction fee to both the buyer and seller's real estate agent. And that transaction fee is 6% of the property sale price. So for our $600,000 our $600,000 sale price here, we have to pay $36,000 in transaction fees to our buying and selling real estate agents. And so if you consider the effective profit on this after the cost of paying the agents, the profits are significantly reduced. Here we're making $564,000 on our investment instead of the $600,000 that we thought. And so that's just the kind of the reality of dealing with real estate, is high transaction costs. And you also need a large investment. So if you want to buy real estate, you often have to put 20% down, particularly if it's not for living in. If you're going to buy it and rent it out, in other words, 20% down is kind of the minimum amount. And if we're talking about a $500,000 investment property, then the expense there is that you've got to have $100,000 in cash just to make this purchase, $100,000 down payment. It can also be a hassle sometimes dealing with tenants. If you don't like dealing with people, and if you want to still manage the property by yourself and not pay for a property manager, then dealing with tenants when they have problems can be kind of an unpleasant thing. If you don't want to deal with tenants, you can get what's called a property manager, but they charge often around 7 to 10% per year of the amount of the rent. So there's an expense involved with that. Now, the book mentions things other than real estate that are high-risk investments like collectibles, metals, and gems. I would almost suggest to you that these are not investments at all. They may have importance, like personal importance to you, but making a profit on collectibles is extremely difficult. And I wouldn't recommend this as any real investment other than for your own pleasure of having those collectibles. But don't expect to make money off of this. And the textbook also explains these things called options and futures contracts. These things are originally designed to reduce risk by something called hedging. Hedging is a topic that's more of an advanced course in finance. As far as options and futures contracts for the purpose of just making money, let's just say it's not an easy way to make money. It's a very easy way to make money or to lose money just as quickly. So again, I wouldn't see these as, without further education, an option for investment relative to something like real estate. These require a lot more analysis and experience with. But with that caveat in mind, I can just explain a few definitions and what options contracts are and derivatives in general. Derivatives are these things that are linked to investments. Like, you can get a derivative on a stock, and the performance of that derivative, the financial performance, will be linked to the financial performance of that stock. And the reason why people get attracted to that is that the stock may go up by 10%, but the derivative on that stock may go up by 100%. So for that same 10% movement in the underlying stock, an option on that stock may go up by 10 times the amount. But the opposite of that is that then if the stock falls by 10%, then the loss on this option is going to be 100%, losing 100% of your money. So options get you volatility, but it's not a clear path to investment profit. Options are typically written on stocks. They're for a finite period called the expiration date. So I can buy an option on Apple, for example, that will last only for 6 months. And then there's the strike price, sometimes called the striking price. This tells me at what point Apple needs to move to in order for this option to be profitable. If the stock for Apple is $800 right now, and my strike price on an option I buy, call it a call option, is $850, then this option will only be profitable if the price for Apple moves up beyond $850. Apple must move beyond $850 in order for this option to be profitable. Otherwise, it's worth nothing. The money that you paid for that, you'll lose 100% of that. So options can be risky. And there are put options and call options. A call option is what we just looked at with that Apple example. Put options are a way to get the opposite of that. That is, it's a way to bet on the fall of Apple instead of a rise in Apple. But otherwise, exactly the same idea. If you really get into this, one thing you can still use options for and still have a relatively low amount of risk is something called a covered call. So definitely, if this really excites you and you want to research more, look into something called covered calls. That's a wiser investment strategy than just buying options outright, which is called a naked option, by the way. Futures, different, but similarly risky. It's another type of derivative contract. Futures markets, again, are often used by hedging. That's what they mean by economic need here. It allows things like, if I'm a grain producer, I grow corn in Nebraska, and I want to make sure that I can sell my corn for a specific price after it's grown 6 months into the season. I can use the futures market to effectively lock in the price at which I can sell my corn, even though the corn's not grown yet. So there's an underlying economic use for these futures contracts, but because futures contracts, like options, involve a lot of leverage, a 1% movement in corn might give me a 100% movement in a futures contract. It attracts people who like to just kind of gamble with futures contracts. And there's nothing inherently unethical or wrong about that. It's just that it's a very risky investment prospect. And so without really taking a course on it, I can't recommend investing in futures contracts at this stage. So the takeaway, I think, is that real estate and these other types of high-risk investments are really appropriate for the most sophisticated investors, for people who are really digging into these investment options kind of as a career or if not a career, a significant specialty that they devote a lot of time and education to. Out of all of these that we looked at, though, real estate is probably the one that you're most likely going to get experience with. I mean, a lot of people have day jobs, normal jobs, and they rent out a property or two. That's a normal, kind of common experience. And it can be a profitable one, too. Just as a number one rule, though, if you do kind of go that route, where you do have properties that you rent out, just make sure that you've always got enough money set aside in another account in case that you need to make repairs suddenly, or in case that your tenant stops paying rent and you still have to pay the mortgage. So with real estate investing, the number one takeaway, I would say, is to make sure you've got enough cash somewhere so that you can account for these types of rainy days when inevitably these types of things happen.